Hello, and welcome to the briefing on the Florida property insurance market. Thanks to all of you for tuning in to what promises to be a very interesting hour coming at the perfect time. Hurricane season starts June 1st, and the NOAA's forecast is that it will be a very active one. AM Best is celebrating its 125th anniversary this year, and for 125 years we have stuck to our mission to strengthen the solvency, stability, and sustainability of the insurance industry. And our ratings have stood the test of time through hurricanes, wildfires, earthquakes, man made events. Today we talk about Florida and hurricanes. The Florida legislature enacted a number of reforms over the last couple of years. In particular, assignment of benefits is no longer an option for policies issued after Jan 1, 2023. There was a repeal of the one-way attorney fees. In response to anticipated reinsurance rate increases, the 2023 season also established the FORA reinsurance layer. And at the same time, the state has been investing in home fortification programs in the spirit of prevention being better than the cure. More recently, in order to encourage private participation, the state has also allowed certain surplus lines insurers to take out policies for secondary properties from citizens for homestead properties or second homes, as long as the surplus lines insurers have financial strength rating of A minus or better from AM Best. I am Sridhar Manyam, Head of Industry Research at AM Best, and I'm here to discuss the future of the Florida insurance market with experts in this space who are going to offer their diverse perspectives and add wisdom to this topic. We will meet the panelists in a moment. One note, we may mention the subject of financial strength ratings. A full explanation of our financial strength ratings can be found at www.ambest.com, and the opinions expressed by our guest panelists are theirs and not necessarily reflect the opinions of AM Best. In the spirit of participation, if you have a question or a comment, please use the questions tab in the player, and we will do our best to recognize your question during the program. Now, it is my pleasure to host a panel with such diverse perspectives. We have two of the best and brightest from AM Best, Don Walker, Associate Director at Industry Relations, and Josie Novak, Financial Analyst who follows the property insurance market very closely and is knowledgeable about the Florida insurance market. We are also honored to have two guests join our program. Randy Fuller, Managing Director for North America Treaty Insurance at Guy Carpenter, and Dave Newell, Vice President of Membership and Industry Relations at the Florida Association of Independent Agents, a very important stakeholder in the Florida insurance space. I'm going to let my guest panelists do the honor of introducing themselves because they've got extremely good pedigrees and I want them to share their expertise. So Dave, can you go first, please?
I can. Thank you so much. And thanks for this opportunity. Again, Dave Newell, Vice President of Membership and Industry Relations here at FAIA. I've been with the association about 15 years, but my background is I started, many of you will remember a company there based in Hartford named Aetna Property and Casualty. I started there in the mid 80s as a claim rep. Moved from Jacksonville, where I was raised, and to Tallahassee. Became an independent insurance agent for about 10 years, and then been with FAI for about 15 years. So my background is pretty diverse. I'm here in Tallahassee now, and certainly look forward to this opportunity talking to you about the Florida marketplace.
Thank you so much, Dave. Randy?
Yeah, thanks. Randy Fuller. I am in Guy Carpenter's Tampa office, and I head up our Property Center of Excellence for North America as well as the Florida segment. I've been at Guy Carpenter and working in the Florida market for about 20 years.
Thank you, Randy. And Josie, could you start us off with AM Best data and analysis on the Florida market that we recently published?
Yes, absolutely. So to start us off, let's talk about, what got us here. In the past handful of years, we've seen more frequent and severe weather events compounded with a macroeconomic and litigation environment that has led to volatility throughout carriers' operating performance and capital levels. This changing market dynamic led to several insolvencies, over the past 3 years. It also led to the Florida Insurance Guarantee Association, which was implemented to fund outstanding claims as a result of these insolvencies. Another fallout of insolvencies was remaining carriers either stopped writing or limited writings of new business in the Florida marketplace, which then led to increased policy counts at the state-backed Citizens Property Insurance Corporation, since consumers needed some place to place their home insurance. The emergence of higher loss severity and weather activity led to more losses being absorbed by reinsurers, which in turn has led to a hard reinsurance market, with reinsurance carriers raising their rates, implementing higher deductibles in order to protect their own financial position. And this put further strain on primary carriers, reducing primary carriers' margins, which in turn passed successive years of significant rate increases to their consumers. And in order to combat this hard and legislative environment, reforms were passed that are expected to have a positive long-term effect on carriers. And while it's too early to tell the long-term effects, some of the near-term effects we have seen include lower lawsuit counts, as well as lower direct containment costs, or DCC costs, which we're going to talk about next. So DCC costs. Let's talk about the trend we've seen in that, if you want to. So now this analysis is based on aggregated results of Florida specialist insurers identified by us here at AM Best. These are predominantly write personal property in Florida. It excludes Citizens as well as insurers with ties to larger national organizations. Now we can see DCC costs have been on the rise over the past 10 years, even as AOB reform was enacted in 2019. Direct containment costs, we can see it hit a spike in 2022. Attorneys rushed to push lawsuits through before new tort reform was passed in December of that year. DCC costs have hindered profitability throughout the past handful of years. Insurers have spent about $2.3 billion on direct containment costs over the last 5 years. And companies finally got, a little bit of a reprieve in 2023 as direct containment costs have declined in the first year post-legislation, as well as supporting profitability for these carriers. DCC costs declined more than 50% to about $307 million from a 10-year high of $650 million in 2022. But now we are only a year and a half post-legislation, so time will tell if this trend is something that's going to be sustainable, but so far we have seen a decline in catastrophe litigated cases. Now, lower DCC costs is one thing that has led to improved results in 2023. Don, if you want to. So this is looking at pre-tax operating. So we can barely see that blue bar for the Florida personal property in 2023. So they did report a pre-tax loss of about $2.4 million, while Citizens reported a pre-tax profit of about $763 million. You can see a profit has not been generated for the Florida specialists since 2015, meaning underwriting volatility has been so profound that net investment income has not been able to offset it. But we can see a trend of improving profitability from 2020 to the current years with these Florida carriers. Now, keep in mind, Florida did incur only one hurricane in 2023. Hurricane Idalia, we saw at Category 3, which, while still causing significant damage, took a path through Florida that was through a less populated area of the state, translating to lower losses for these active Florida carriers. Comparing this to 2022, when we saw Hurricane Ian make landfall as a Category 4, in a more heavily populated Southwest Peninsula in Florida. So the area of impact had a big effect on results for Citizens, who reported pre-tax losses of over $2 billion. While active companies reported losses of almost $400 million pre-tax. Now, the year-over-year improvement has been favorable for active Florida companies as well as Citizens. However, we've all heard the NOAA is projecting an above average hurricane season, so time will tell if profitability is here to stay. Next, we're going to translate these pre-tax operating returns into combined ratio performance. So this slide outlines two different trends we're seeing. First, the blue line is going to identify active Florida personal property companies that have been identified here within AM Best. They exclude Citizens as well as insolvent companies. And the red line is our personal property composite that as a whole throughout the nation. So we can see here that the rise in litigation costs and direct containment costs have been affecting insurers, as far back as 2015, as combined ratios have escalated over that period. Then you lay on the hurricanes in 2017, 2018, 2022, it becomes a difficult market to participate in, and you can see Florida companies are underperforming that personal property composite almost by the same margins, from 2018 through 2021. But we can see the gap starting to close, in 2022 with the lines finally inverting in 2023.
Thank you, Josie. And Dave, I'd like to bring you into the conversation. For people who are not very familiar with the Florida market, or even people who might be familiar, they would definitely love to hear your perspective on how we got here. How have the reforms that have happened last year, and have agents seen a difference in the Florida market since it has become law?
Yeah, and again, thanks for showing the slides up there. I just want to first just point out a couple things, and I'll get right into where we are today. Our association has been around 120 years, serving independent agents here in Florida. And as you see our mission there, it's to serve the needs of the Florida insurance agents and consumers by promoting a healthy and competitive insurance environment. So that is our key mantra that we deal with every day here at the association. And so just wanted to start out and give you a little bit background for those that are not familiar with our association. Next slide. And that's the one I really want to talk about. Our association represents about 2,000 member agencies, which equates to about 25,000 insurance professionals here in Florida. So we do have a pretty good idea of the marketplace, and certainly agents that are participating in the Florida market from a property standpoint, and certainly other lines of insurance. So I just wanted to give you some general idea about that. The other thing that I always start these talks with is a stat that, if you don't mind me reading something, a stat that the OIR has put out recently, again, just reaffirming some of the statistics that are kind of alarming. And the Florida Office of Insurance Regulation reports that 9% of the nation's homeowners claims are in Florida, but 79% of homeowners insurance lawsuits also derive from Florida, which skews the numbers certainly nationally quite a bit. Over a 10-year period of time, 71% of the $51 billion paid by Florida insurers went to attorneys and public adjusters. So that kind of sets the background of where we are, where we've been, and hopefully with the legislation that's been passed, will bring us in a new chapter of the Florida marketplace. And again, the system didn't get broken overnight. There's three main factors that drove some of those numbers. Certainly public adjusters seem to be on the rise. For those that don't know, we had two major tornadoes here in Tallahassee over the last 2 weeks. And within a matter of minutes, quite frankly, folks, public adjuster signs were popping up everywhere, which certainly doesn't even give the chance for the homeowner and or the carrier that insures them an opportunity to start their claim process. So that was one of the things. The other thing that was created that drove a lot of this was a cottage industry, that we call it, of contractors, whether they're roofers or plumbers or heating and AC contractors, that were going out into neighborhoods kind of talking to homeowners about claims and about the ability to file a claim, the ability to certainly handle the claim, which led to AOB abuse, which we know has now been statutorily outlawed here in Florida. So that was factor number two. And then certainly the one that drove the numbers that I just talked about were the onset of litigation and third-party intervention that drove a lot of the costs that carriers were having a difficult time, rating for, right? Because they can rate, they're very good at rating for the risk at hand, but some of those extra costs, extra expenses that Josie talked about, you can't rate for those. So those factors. So with the reforms, AOB is now statutory. Tort reform has been a godsend, quite frankly, here in Florida. That's been very helpful in carriers trying to contain costs. And so we've seen some stabilization. We've seen some carriers open up capacity. We've actually seen, and this has been several years, folks, anybody in and around Florida, agents have not been able to be appointed for carriers for quite a while. They've kind of stuck to their agency plant and helped promote those agents. But we've now seen some new capacity and some new mindset of carriers opening up and appointing agents to write new business. So those are signs that the reforms are working. It's signs that there is some stabilization of the marketplace. But the last thing I'll say is we're cautious. We don't want to be too rushed to judgment here. The process still has to work, and we want to see some of those reforms get some history behind them, and so the market can continue to be stabilized, and the economy here in Florida for agents and consumers will be healthy again. So
Great.
That's where we are.
Great perspectives, Dave. I think our report also echoes your views, right? I mean, we are saying that we are being a little cautiously optimistic. And,
Exactly.
Yeah. And it's a wait and watch. So there's still the hurricane season to go. Don, obviously, Florida being an important part of the reinsurance market, and reinsurance is an important risk management tool that are being used by primary carriers to manage their risk there. What is AM Best's outlook on the global reinsurance market?
Right. So the current view of the reinsurance segment from AM Best's perspective is that the market outlook remains stable. If I can call your attention to the chart here, these are some of the positive and negative drivers that are influencing the market. January 1, 2024 renewals achieved favorable pricing and terms and conditions. One of the differences from the 2023 renewals was last year there were some discrepancies in the expectations of cedents and how rates and terms and conditions would play out for the market. In terms of expectations now, 2024 renewals, they were a little more orderly than prior year. One thing to note for the January 24 renewals is there was a clear objective to improve underwriting margins. And just like in 2023, we see carriers still looking to play in those most remote layers. We do still see ample capacity in those remote layers, and we don't expect to see them come down in the near term. The demand for reinsurance is still high, especially as catastrophe losses and elevated property value growths continue to plague the sector. But reinsurers are staying disciplined in their strategy, again, to improve and maintain underwriting performance. We've seen a rise in investment income. This has helped a lot of reinsurers with investment losses. A rise in new money yields does improve overall operating returns. However, the rise in rates also results in a materially higher cost of capital for reinsurers. As market conditions and efforts to de-risk have led to improved conditions, we say paucity of reinsurance capital is still pronounced. New capital, while available, is hesitant. Availability does not necessarily equate to being readily deployed. Again, reinsurers are remaining disciplined in their overall strategies to sustain positive results, and that includes flight to quality. So we do see some concerns with how some casualty books are behaving in terms of how they have been underwritten between 2016 and 2019. Some casualty reinsurers have reported pockets of adverse reserve development, which has been triggered by social inflation. So you're going to see some U.S. players are reducing their exposure in higher volatility property casualty risks. So just to kind of summarize the economic and external environmental changes that we've been seeing, reinsurers remain well capitalized. But again, they're cautious and they are very discerning in how they want to deploy that capital. Technical results are continuing to improve, and we really do expect at least a few more years of these strong technical results to work their way through the market. Demand for reinsurance remains strong. Established reinsurers are at an advantage here. They can raise capital to support expansion through a hard market. And we do see certain consolidations in market positions, and not just because of the flight to quality. Cedents are going to come into the market looking for well-diversified and broad offers. High risk-free rates do translate into higher cost of capital, which can present a challenge for potential new entrants. And well, then there's the overall present complex and evolving risk environment that continues to cause concern, and some carriers are going to face challenges in that regard when they're trying to develop and use tools that allow them to price new and emerging risks.
That's fair. Thank you so much. And Randy, I would like to get you in the conversation at this time, especially with the reinsurance commentary. How are you seeing the reforms impact the market, and how has the market in general reacted to these reforms, and how has the risk appetite in the primary and the reinsurance market changed?
Yeah, thanks. So I think what I'll do is just give a broader view of what we're seeing in the Florida market and the reinsurance market, and then kind of weave in how the reforms have been having an impact along the way. But as Josie mentioned, we're now about 18 months under the new law, which has given us some initial indications as to whether the reforms will be effective, and we really saw pretty immediate impacts, as we saw in some of the financial results there, right? Claims frequency came down pretty quickly after the passage of the reforms. And with the improving financial outlook, we also saw risk appetite return to the market. And a big part of that, we saw Citizens takeouts start to increase again after pretty minimal activity in depopulating Citizens. Pretty meaningful depopulation sort of toward the end of 2023. So a lot more risk being transferred back into the private market where it belongs. Also included in the reforms were a few measures that were intended to help improve or facilitate or entice people to take out business from Citizens. And I think those measures have also been helpful. Cat events always play a big role in the Florida market. And thankfully in 2023, we had relatively little impact in Florida. More broadly globally in terms of cat losses, it was a little bit lower in 2023 than we had seen in the prior few years. So that was also helpful for the reinsurance market, especially on the back of some of the changes that we saw in the market over kind of the 2022 and 2023 renewals, where retentions and terms and conditions were being adjusted. So reinsurers actually did pretty well in 2023 after a pretty tough stretch of heightened cat activity, which was, much needed. So as we look at the market now, so far in 2024, really we've set up for a pretty stable market environment. Given that reset that we saw with pricing, with structures, January 2024 was incredibly stable. And then as we've headed through the rest of 2024, we've seen that stability really kind of hold firm. So we continue to see a stable market going forward. And really, maybe flip to the next slide. As we kind of think about market conditions, we often look at excess capacity, because the amount of capacity available in the market is often a driver of what's going on. And so the chart in front of you is a measure of excess capacity. That is basically the amount of reinsurance capacity that is over and above what is actually purchased. And so probably focus here on the right-hand side of the chart, which is the most recent few years. And one thing that I think you'll see on the chart immediately is that January 2023 was sort of the low point of capacity in the reinsurance market. And that was really where we saw rates accelerate. We saw big changes in retentions happen very suddenly. But we saw capacity really rebound pretty suddenly in the second half of 2023. So you can see that orange bar there, rebounded very quickly after all of the market conditions were kind of confirmed, right, in terms of rate and everything resetting to where the market felt it was adequately priced. But if you look at Florida, which is going to be in the mid-year renewal, so those are the orange bars. The low point for Florida excess capacity was actually during the 2022 renewal season, just prior to the reforms, and that the reforms really played a big role in restoring confidence in the Florida market, and that brought risk appetite back so that we could see that rebound in 2023. As we've moved forward, you can see that the capacity situation has remained pretty stable for January. We're continuing to see that through the April renewals, and we're also seeing it now as we're kind of working through the June renewals. One thing to point out there in the top right corner, you can see we've broken down the Florida capacity by excess capacity at different points in the program, and to Dawn's point earlier, we did see a bit more constrained capacity at the bottom of programs, and we've seen that really globally, not just in Florida, and much more excess capacity in the upper layers. We continue to see that in the market at this point, although we are seeing increased appetite for some of the lower layers at the right price. So we do think some risk appetite is coming back into the market for some of the lower layer business. Next slide, please. I think the big thing for reforms at this point is, we know that the reforms are having a significant impact. As kind of just as they were passed, I think the market really applauded it. Lots of cautious optimism kind of continues to be the term that everyone's using. But I think the biggest challenge for the market now going forward is really quantifying, what the new view of risk in Florida is now going forward. It's a bit more challenging than it probably seems like it should be, because what it becomes is there's been years and years of this experience or poor experience that people have had in Florida surrounding the fraud and litigation and everything that was in play, and pricing and risk appetites and everything have now adjusted to kind of meet that level, right? But now that that's changing, it becomes quantifying. Okay, well, now that we're operating under a new environment, what does that mean for pricing? What does that mean for loss costs? And it's going to be challenging to quantify that. We're already seeing a lot of very strong data points from carriers around non-cat losses, because there are going to be claims day in, day out, lots of data there. But it's more challenging for cat because there's not quite as many data points, right? We only have usually a few of them a year, if any. And so, it's going to be more challenging to string together those data points around, how things are performing post-reform. That said, I do think that we did have a few data points in 2023 post-reform. Mentioned Idalia earlier. I know it did not hit a major populated area, at least directly, but it did bring tropical storm force winds to areas like Tampa. I believe that, had Idalia happened in the prior legal environment, we would have seen a more significant loss situation there, because it didn't really take much under the old law to generate significant losses. And so this is where the challenge comes in, because it's more difficult to quantify losses that didn't happen. For instance, quantify claims that weren't filed because there was not a door knocker there to generate the claim. And so, that's the challenge that we're going to have to contend with here to go forward in order to make sure that we're pricing risk accurately going forward under the new environment. It's going to be an ongoing evolution, but expect that the reforms should result in Florida property insurance and reinsurance being a more sustainable business going forward, ultimately coverage becoming more affordable for Florida policyholders, which is really the ultimate goal. in recent weeks, we have seen a few Florida carriers come out with single-digit rate decreases, which I think is a positive step forward. Sometimes the industry kind of looks at rate decreases as negatively in terms of looking at the profit outlook, but I think there is definitely room here for rate reductions alongside improved profitability as we move forward in this new legal environment.
Thanks, Randy. Dave, anything in terms of this cautiously optimistic view of the Florida market and encouraging signs initially in the 18 months, do you think national carriers are going to come back to Florida or, increase their presence if they're already? What are you seeing in terms of those signs?
Yeah, so the national carriers that we've spoken to, and many of them are members of our association, would like to come back. They feel the environment is better. It's better suited for their business model. As we call it, as I call it, they want to dip their toes back in, maybe look at some capacity, maybe look at some lines of business that they can be successful in because of the tort reform. Um, Agents are optimistic that some will come back. We are as well. But I will tell you, just like we're all talking here today, everybody's optimistic. But I think from a national perspective, it's going to be a slow, deliberate approach, right? They don't want to open up capacity too much. They want to see more results from the reforms, but they also want to make sure those stick. And that's what I think we're all looking forward to, is making sure there's no changes along the way. There's no other reforms that may take away from the good reforms that have already been presented, that will set us back a little bit. So again, cautiously optimistic, but I think they would like to come back just in a slow, deliberate approach.
Thank you. And Josie, as you talk to our rated insurance company management, what are they talking about renewals when it comes to property? Pretty similar to Randy?
Yeah, absolutely. As reinsurance programs renew, carriers' primary concern is the cost benefit of purchasing protection to insulate their balance sheet, but not to the point where they're trading dollars back and forth with the reinsurance companies. Essentially, it comes down to carriers wanting to either increase their retention and retain higher losses, or do they want a higher cost of reinsurance, both of which would affect, their operating performance, which is something that we take into during our analysis. Florida-specific carriers are pretty unique in the sense that their reinsurance dependency is elevated compared to other parts of the nation. Florida carriers are going to be more sensitive to changes in terms and conditions and pricing since they rely so heavily on reinsurance. But from what we have heard at mid-year renewals have been somewhat less chaotic, more orderly in 2024 compared to 2023. There has been capacity available in the market, but still, reinsurers are being selective in terms of deploying that capacity, especially at some of those lower layers. We are seeing a softening, although modestly, in reinsurance rates, with rates being more favorable than primary carriers had, budgeted for. So the scales seem to be tipping towards, these primary carriers, with many programs being fully placed or placed with less co-participation this year, and with plenty of time to spare before the prior year program expires.
Good to see reinsurance performing its role as protecting balance sheet volatility as opposed to earning smoothing effective mechanism. So, Dave, more admitted insurers, right? I mean, we've noticed this trend. More admitted insurers are entering the market in the form of reciprocals. How are agents looking at this change? I mean, it's encouraging to see this because they're all admitted, or how are the agents looking at this?
So, quite frankly, for many agents in this state, for sure, the reciprocal model's been kind of foreign to them, right? I mean, many of them can point to USAA or Pure to see, but a lot of independent agents don't represent those two particular carriers, and I know there's many others. So a lot of it is around education. Educating our members, the agents, of what a reciprocal model is, how it works, what are some of the nuances that they're required to explain to their clients about this new model, moving away from the MGA model. And some agents were concerned about was there a different errors and emission exposure, right? Was there something there that they need to be concerned about because we were moving away from that MGA model? I think once that was all really explained and talked about, agents became more comfortable with the concept. They became more comfortable with explaining the differences with their client. They were certainly encouraged that there was new capacity, new capital coming into Florida through these reciprocal models to help stabilize the Florida marketplace. But mostly, a lot of them, because of the relationships that some of these carriers had in their previous life, as we may call it, a lot of the agents were familiar with some of the leaders of these companies. So created a more of a comfort level. And so there was more of an adoption and an understanding. So I think from our perspective, and certainly the agent's perspective, the reciprocal model has been welcomed, it's been adopted, and it's certainly something that they look forward to of others coming into the state of Florida bringing capacity. So.
Thanks, Dave. You mentioned MGAs, and thankfully we have an expert on MGAs here. So, Don, if you could move to the next slide. Yeah. So, when AM Best did its analysis of specific causes of impairment of insurance companies between 2000 and 2022, the top three reasons, if you can see, are catastrophe losses, fraud, and affiliate programs. All three of them very closely associated with Florida. Catastrophe losses, of course, Florida is very hurricane prone. Fraud, I mean, especially till the AOB reforms and contractors, roofing, lots of alleged fraud in the insurance industry taking advantage of these laws. And the third reason, of course, is the affiliate programs. Don, how are you seeing MGAs play out in Florida that Dave mentioned as we look out at this new wave of insurance companies and business models that are proliferating there?
Yes, Sridhar. We're seeing a response to this in participation of MGAs due to the recent legislative reforms that really aim to stabilize the Florida market in terms of competition, diversification, and really just trying to battle the myriad of issues on several fronts. Like you said, catastrophe losses, litigation, coverage availability, and really the skyrocketing premiums from the policyholders' experience. But there are still a large portion of premiums dollars that are being sourced via the delegated underwriting authority enterprise distribution channel. And as Dave mentioned, there has been an increase in reciprocal exchange companies coming into the market. But I want to note that MGAs are also using these alternative structures to evolve their business models. So you are and can see MGA sponsoring reciprocals, being attorney, in fact, sponsoring captives to take on more risk, MGU incubators that are pulling in that investment capital, and as well as other hybrid structures. The unique thing about this is that these companies can function as an MGA and manage a reciprocal or captive or hybrid simultaneously, and these business structures are viewed as durable and sustainable models. The beneficial relationship of these structures still exists, just like any traditional relationship with the MGA function, with the company relying on the delegated underwriting authority's specialized expertise in handling administrative and underwriting functions, and while the delegated authority benefits from that capital structure of the business. This shows the flexibility of the sector. It shows its ability to continue to push innovation and evolve the market. To date, in 2024, Florida's Office of Insurance Regulation has approved 8 property insurance companies to begin operations in the Florida market. If you see here, I have some of them listed, but I just wanted to kind of point out just a couple of these property insurance companies to show how MGAs are working also within this structure. So Orion 180 Select, they started out as an MGA. They've since have transferred into like a full stack insurance carrier where they've launched its own surplus lines carrier, establishing their own underwriting capabilities. And just another example is Amenity Insurance Exchange. SafePoint Managing General Agency manages the policy administration and claim servicing for Manatee Insurance Exchange. So I would like to note that Manatee Insurance Exchange itself does not operate as an MGA, but it just really shows you how MGAs are still playing in the space and showing their flexibility. So the overall number of MGAs in Florida fluctuates as companies fluidly enter and exit the market, but we are seeing an increase in MGAs still coming to play and being active in the Florida market in support of those stabilization efforts that have been put in place.
That makes sense. So, coming to the E&S market, I think all of you guys talked about different safety valves or releases, if you will, when the admitted market is either reluctant to take on risks or cannot price its risk. So one of the other safety valves is the E&S market. Dave, are you seeing more of the E&S market appetite increasing in Florida?
Yeah, without a doubt. I mean, we've had the E&S market in this Florida marketplace for a long time. It's filled the gap for sure. It's filled a void in many parts of the state, including personal lines. You know, it used to be just the commercial side of the business, but even the uptick in personal lines for the higher valued homes and certainly those that can't find coverage in the private market. And as we know, if not all of them, most of them are rated by AM Best, and so it creates a comfort level for the agent. It creates a comfort level to discuss what that rating means to a homeowner or prospective business owner, and so that to me means an awful lot to the consumers and the people that are working with surplus lines. Not only brokers, but agents that represent and are selling that product to the Florida marketplace. So they continue to fill the void. They continue to help meet the needs of consumers in Florida, and agents have a lot of confidence in knowing that AM Best is rating them, is reviewing them, and has the ability to make comment about some of these companies as they go along the way. I mean, we just had a situation this week. I'm not going to name the company, but just had a situation this week that, some of the agents called me about just getting a little more information about the particular carrier because they were going through some review. There continues to be a lot of, information and back and forth and exchange from agents that want to know about certain companies, especially in the E&S market.
Thanks, Dave. And no discussion of Florida can be complete without discussing citizens, right? And then I know the state wants to rightly, depopulate and de-risk citizens. Dave, maybe I can ask you, how is the depopulation efforts affecting consumers and agents trying to affect the business in the state?
Well, as I said on the onset, I've been here 15 years, and so we have seen the ebb and flow of the population of citizens, right? And now they're at their peak again, and certainly it's not sustainable. So the depopulation efforts, though, through the years, and we have been encouraged that citizens has certainly listened to agents, they've listened to consumers, and kind of have refined that process. And so agents are encouraged. They certainly can have those conversations with their customers of why it's important to accept a takeout offer and go back into the private market where the risk should be. Having conversations with their clients about the accessibility of citizens, right? Because that's certainly a risk that some people in citizens will take on if they're there when an assessment has to be levied. So I think this entire process of depopulation, certainly reducing the size of citizens, reducing the exposure to the citizens of Florida, so to speak, has been healthy. It's been good for the marketplace. And again, it's another good sign that stabilization is ongoing, and it's again optimistic about what the future holds for agents and consumers of Florida.
Randy, maybe Citizens has been in the market for relief through reinsurance and the ILS market as well. Just could you comment on those efforts as well, if you don't mind?
Yeah, sure. So with the growth in Citizens over the last few years, the exposure to the state and to policyholders within the state, continues to escalate with that growth. For those that aren't familiar with it, basically, if Citizens' losses are too great, assessments can be levied not only to Citizens policyholders, but if it's bad enough, assessments can be levied on all policies statewide, even outside of Citizens. So, in order to help reduce the likelihood of something like that happening, reinsurance plays a big role in keeping that risk manageable. Expect that'll continue for the foreseeable future. I think this year they were targeting something in the neighborhood of $5.5 billion of total coverage, which is up by about 1.3 billion. So, they are adding to that increased demand that we were talking about earlier. Pretty significant amount of capacity. But with the 2024 renewal discussions kind of still kind of wrapping up here, that's about all I can add at this point.
What are the trends we are seeing from our analysis in terms of Citizens and policy growth?
Yep. So Citizens, being designated the state's insurer of last resort, saw their policy counts swell over the last 2 years because of insolvencies, because of carriers pulling back on their exposures. So in the last 3 years, 10 companies have been declared insolvent, due to the micro and macroeconomic environment, the litigation environment. So September of 2023 is really when Citizens policy counts reached their heights. They had a high of 1.4 million policies in force in September of 23. But since then, the depopulation program has been implemented. We've seen a reversal, albeit slowly, of that climbing policy count. As Dawn had mentioned, the Florida Office of Insurance Regulation had approved 8 property and casualty insurers to enter that Florida insurance marketplace in 24. And as David said, this continued entrance of new market players shows the market's continuing to stabilize and gain strength. And there's also continued interest, from authorized carriers in the Citizens Depopulation Program. In 2023, we saw 275,000 policies assumed from Citizens, which reduced their exposure by about $113 billion. And through April of 2024, 11 companies are currently participating in the depopulation, with about 114,000 policies removed in that time frame, since year-end 23. The Florida Office of Insurance Regulation has approved 13 companies to assume a total of 354 policies by the end of the year from Citizens.
And how are the? Sorry, Dave, go ahead.
And just I was just going to point out, and for the first time in many, many years, we've had a commercial takeout, and so that again is an encouraging sign. Most of the carriers on that list were personal lines, but we now have core in the group that is on their second takeout for commercial lines, commercial residential, matter of fact. So that again is a positive sign of what's happening in our market.
Good to hear. Good to hear. And Randy, clearly Florida is all about hurricanes, but recent tornadoes and kinetic storms have also made aggregate exposure a lot more important. So, what are the conversations that clients are having with you about increasing secondary perils in terms of their coverage?
Yeah.
Yeah.
Yeah, it's an interesting question, an interesting topic. And we've certainly seen heightened SCS losses really nationwide over the last couple of years. We've also seen pretty significant activity already so far in 2024. So it's definitely at the top of minds for many carriers across the country. I think the market right now, the industry generally, is trying to understand whether we should expect continued increases in activity, whether things will level out, whether they'll revert back to lower, previous levels or averages. It's really challenging to make sense of some of the recent activity and what it means for evaluating the risk. The industry is really hungry for tools to help assess risk. And, in Florida and also nationwide, really, we've been helping clients assess SCS risk through risk scoring or adding risk scoring into the mix, using that information to supplement things like loss experience, CAT models, and then using predictive analytics that can help to better help carriers better underwrite and price risk more accurately. So, that's one area. But when we look specifically at Florida, another element here as we kind of bring the reforms back in, is that we believe that a lot of the losses that came out of Florida for these smaller events, SCS events and things like that, a lot of the losses coming out of that were driven by fraud and this litigation engine that the reforms really targeted. So we do think that that's going to help improve the risk profile for SCS losses in Florida. And we're already starting to see some encouraging data around that. Now that we're 18 months in from the reforms, we're starting to see how some of the smaller SCS events that occurred last spring are kind of developing and playing out. And we had a specific instance where there was a meaningful SCS event that occurred in April of 2023. We're now a year after that, right? So it's had a full year to develop. And what we did is we compared the development of that event to the development pattern of similar events over the past 5 years. And had this event developed in a similar way to those prior events, the outcome would have been at least 2 or 3 times where we're seeing that event kind of land today. So, pretty encouraging. I think most of our clients in Florida believe that, the reforms are going to have a meaningful impact in reducing SCS losses. But there's also been, a lot of work done over the last several years on the quantification side of things to kind of make sure that people are focusing on it. As you said, Florida is all about hurricanes, but there were a lot of carriers in non-hurricane years that took a lot of losses from non-hurricanes, and so that's been underway for several years now.
All right, and Josie, one of our key factors that drove the negative outlook on our homeowners insurance market segment was increasing secondary perils, increasing climate risk. As a rating analyst, how does AM Best look at the financial strength of an insurer on the aspects of cat risk, price adequacy, capital, so on and so forth, as you look at all these increasing frequency of weather events?
Yeah, absolutely. So we know Florida is a hurricane-prone state. That's not something that's going to change. Rated insurers are aware of the risks inherent in the Florida marketplace. This includes the secondary perils and non-modeled perils that we've talked about, as well as the continued rising claim severity amid the inflationary environment. As part of enterprise risk management programs, rated carriers are redefining their exposures. They're managing their geographic and product distributions, as well as risk accumulations through reduced appetites and strategic non-renewals of underperforming policies, all while strengthening their underwriting guidelines. And catastrophe risk and managing this risk is something, as you said, we consider as part of our ratings process. Then in terms of price adequacy, Florida insurers have been playing catch up the last few years to return to price adequacy. Successive years of large rate increases have been pushed through, to keep pace with that rising reinsurance cost we talked about and claim severity. 2023 carriers' operating performance did reap the rewards of higher rates earning in and stricter underwriting guidelines taking hold, along with benefiting from the impact of the legislative reforms that we have talked about. A positive signal in the market in 2024 is, as Randy had said, some companies are believed to have reached rate adequacy, as we've seen 8 companies have filed rate reductions, although marginally, while 10 have filed to keep rates flat. And lastly, capital adequacy and balance sheet is something else that we take into account in our ratings process. The improved performance in the sector in 2023 led to capital appreciation of about 23%, or $532 million for these active carriers writing in the marketplace. Carriers are still working to produce consistent year-over-year capital appreciation. However, in 23, we saw that capital was less reliant on capital contributions than in previous years for aggregate growth. In 2023, about half of the capital appreciation, just under $350 million, came in the form of capital contributions, while in past years, we saw contributions outpace the surplus growth. So this was the first year that surplus growth has been achieved, net of contributions. But again, time and severity of hurricane season will tell if this is a trend that's here to stay. And now we just have to say, some capital contributions in 2023, as well as years prior, came in the form of capitalization for new company formations, which does not necessarily, reflect contributed surplus to buoy capital. And not all Florida specialist writers did receive capital contributions. But surplus volatility, risk-adjusted capitalization is all part of our rated company analysis. We want to see a stable trend in those metrics, and we want to ensure our rated carriers have an appropriate level of risk-adjusted capitalization in order to support their operations.
Excellent. Last question to you, Dave, taking cognizant of the time. Why don't you touch briefly on the My Safe Home Florida program and its effects on the market, if you don't mind, because that's an important component of the overall reform.
Yeah. Thanks for bringing that up, because certainly the program has been very successful. The Florida legislature a few years ago certainly passed some legislation to fund this program. The uptick on it has been tremendous. Again, this year, the legislature set aside $200 million more for homeowners to go through the program and take advantage of not only the inspections, but certainly some of the work that needs to be done to harden your home. We all know on this call, the better our home is hardened, the better our risk is, and the better you have good data, right? Randy talked about it. Having good data on these risks to be able to rate for them is certainly encouraging. I'll tell you, agents are very encouraged to have these conversations with their clients about the My Safe Florida Home program, because they've been preaching it, and now there's some dollars associated with it to help those homeowners maybe achieve a little better home stock or hardening of their home that will sustain, hopefully, on a wind event. And this year, in 2024, the legislature decided to start a pilot program for commercial residential risk, condo associations. I mean, they only allocated about $25 million for that program. So we'll see how that goes. But here at our association, we've had many conversations with, as we call them, condo producers, agents that just specialize in condo associations. And they're very encouraged to have that conversation with their clients. It's not a lot of money, but it's certainly a starting point. Hopefully, the encouraging thing is that people will take advantage of it, hardening some of the association buildings, and then next year go back to the legislature to get more funding, because the My Safe Florida Home program has been a very good tool for agents to talk to their consumers about the need and why you should be hardening your homes here in Florida.
Very good. I think Hurricane Andrew was the first hurricane that brought up significant changes to building codes, and glad to see
Exactly.
that Florida is keeping up with that trend. And like I said in the beginning, prevention is better than cure. With that, I'd like to go to quick closing thoughts. Randy, you go first as a guest. Thank you so much for your time.
Yeah, sure. Thanks. Yeah, I guess I'll just say, it's been refreshing to start to see things turn for the better. And I look forward to seeing continuing improvements as things start to settle in under the new legal environment.
Excellent. Thank you. Dawn?
Sure. So I would like to say market conditions are ripe for opportunities, particularly in the delegated underwriting authority sector, but I will always caution to watch for known causes of impairments and championing building out a sound enterprise risk plan to meet these challenges in a complex market like the Florida market.
All right. Josie?
Here at AM Best, we diligently monitor this Florida marketplace. And as we've talked about multiple times throughout this briefing, we're cautiously optimistic about the market moving forward. But, still a little too early to declare a win in the marketplace, but, signals do look promising moving forward.
Have to have a rating analyst to always be skeptic. Dave, last word to you.
Did you say my name?
Yeah,
Okay.
Last word to you.
Yeah. Again, thanks for the opportunity. For FAI and AM Best have been partners for many years in this marketplace, and we certainly cherish that partnership. We look forward to your team being down at our convention in a couple weeks. But this program really brought together, again, some optimism and some ability for agents and consumers to feel some stabilization, to feel the marketplace shifting a little bit, and the favorable terms, and certainly which will lead to rates. So I thank you for the opportunity to be here on behalf of FAI and the agents that we represent, and certainly more to come. Let's hope this is sustainable into the future.
All right. With that, I would like to thank Don, Josie, Dave, and Randy again for your participation. And thanks to all the audience for watching. We'll have a replay out in the next week or so. Thank you all.